Today, silver ripped higher, hitting levels not seen in years. If you own silver or follow commodities, this report matters because what is driving prices could reshape markets for months. Stay with me because I will explain exactly why silver exploded, what the next key price levels are, which real-world forces are behind the move, and the 3 practical scenarios you need to be ready for. Silver traded around $44 an ounce on September 24, 2025, and has been testing multi-year highs. This rally is not random. Reuters and multiple market feeds confirm the current price action and market context. What just happened? On September 24, 2025, silver is trading near $44 per troy ounce. Global futures and spot markets show prices edging up on the day, with intraday ranges pushing toward the recent highs. Trading platforms report a steady uptrend across spot, futures, and ETF holdings over the past month. This is why physical dealers and futures desks are increasingly tight on immediate delivery. The 5 driving forces behind the rally. Monetary policy expectations. A shift toward a more dovish Federal Reserve outlook this month changed the game for precious metals. Softer rhetoric about the path of interest rates and growing market bets on near-term rate cuts pushed real yields lower. Lower real yields reduce the opportunity cost of holding non-yielding assets like silver and gold, and give precious metals a strong tailwind. Reuters' coverage of central bank commentary and market reaction captures this dynamic. Central bank accumulation. Several official sector purchases and budget allocations are now explicitly including silver as part of reserve diversification programs. A number of countries have quietly increased official demand for precious metals beyond gold, and this structural demand is tightening available surplus supplies for the physical market. Analyst coverage and recent government disclosures document notable official buying activity. Industrial demand fundamentals. Silver is both a precious metal and a critical industrial metal. The clean energy transition is raising long-term industrial demand for silver in sectors like photovoltaics, 5G infrastructure, and electronics. Analysts point to sustained industrial consumption as a core reason why silver's rally is sturdier than prior speculative spikes. Exchange-traded product inflows and speculative positioning in futures amplified the move. When market structure becomes one-directional and momentum feeds momentum, prices can overshoot technical levels and create quick rallies. Recent data shows sustained inflows that matter, because ETF purchases require physical or derivative backing, which draws down available inventories. Technical momentum and scarcity. Signals on the daily charts show strong momentum. Technical providers are flagging immediate resistance and support zones that traders are watching. Analysts are also noting softer available above-ground inventories in the short run, which, combined with demand, increases price sensitivity to any new buying. The concrete evidence today, trading economics and major market feeds are recording silver near $44 an ounce and a month-over-month gain measured in the low double digits. Futures markets show the September contracts with tight ranges and elevated open interest, signs that professional traders are deeply engaged. Local bullion markets in major consuming countries are reflecting that trend in currency-converted prices. These data points validate that this is a global, cross-market rally and not a single market anomaly. The immediate technical map traders and holders should watch. Key support zone, $43 to $43.5 per ounce. If prices close under this area on daily settlement, it would signal a loss of short-term bullish momentum and invite deeper pullbacks to the next structural support. Expert technical commentators have highlighted the $43 area as a short-term pivot. Key resistance zone, $46 to $48 per ounce. A clean breakout above this range on strong volume opens a path to the prior multi-year highs near 56 and higher psychological levels. Some bullish analysts are already citing higher targets if momentum stays intact. 3 scenarios for the weeks ahead with probability-style thinking. Scenario A, bull continuation. The Fed keeps messaging a softer path for rates, central banks and industrial demand stay strong, and ETF inflows continue. Under that view, silver pushes through $46, consolidates, and then targets the next structural levels. Probability estimate given current data, 35%. Scenario B, range-bound with pullback. Markets test profit-taking, data prints show sticky inflation surprises, and real yields lift. Silver then chops between $41 and $46 as traders rebalance. This is the neutral base case. Probability estimate 40%. Scenario C. Reversal under capitulation. A surprise hawkish shift from central banks or a sudden drop in ETF flows triggers a quick drop toward $38 to $39. This is the lower probability tail risk scenario, but it is real and would be swift. Probability estimate 25%. Trading and risk rules you can use right now. If you trade or record a video giving trade ideas, keep your rules strict. For short-term trading, watch confirmed daily closes beyond the support or resistance zones noted earlier. Use tight risk management and size positions relative to total capital. For investors who view silver as a strategic exposure, consider dollar-cost averaging because this commodity is volatile and subject to episodic spikes. Always remind your viewers you are not giving financial advice and that they must assess their own risk profile. What to watch in the next 7 to 14 days. 1. Macro signals. Federal Reserve commentary and the upcoming U.S. inflation prints, including the PCE index and weekly jobless claims. These will be the primary catalyst for flows into or out of precious metals. 2. ETF flows and inventory reports. Watch daily ETF inflow numbers and COMEX warehouse inventory changes because they show whether physical metal is being withdrawn or added. 3. Industrial orders and new product announcements. Any large increase in silver demand in the solar supply chain or electronics will change the supply-demand math over the medium term. Longer-term structural view. If central banks continue diversifying reserves and industrial demand for silver continues to grow, then the structural case for elevated prices remains intact. Some analysts even advance the idea of much higher nominal prices over years as above-ground supply struggles to match growing use and official accumulation. This is why a small allocation, sized appropriately to risk tolerance, can be viewed as a strategic insurance against currency and macro risk. However, this is a long horizon thesis and not a short-term trade guarantee. If you found this briefing useful, give the video a like and subscribe for fast daily market updates. Drop a comment with your view on where silver goes next and what price level makes you nervous or excited. Final strong safety reminder to read aloud. This content is informational only and not an offer or recommendation to buy or sell any security, commodity, or investment. Consult a licensed professional for personalized advice. Commodities trading can lead to losses greater than your initial margin or deposit.